Welcome to our webinar of the power of financial forecasts. I'm joined by my colleague today, David Granick. David and I are both certified financial planners and chartered investment managers. And we're part of the Watson Investments team. Watson Investments is a holistic wealth management company that helps clients manage their investments and financial planning. For financial planning, we help with anything from cash flow, debt management, retirement planning, tax planning, estate planning, risk mitigating, and children or grandchildren education planning. If you'd like to connect with either David or myself, please feel free to email us, call us. We'd really love to hear from you. As well, there's a link going in the chat box. Please feel free to use that link and schedule a conversation with me. Really love to have a conversation to hear more about your financial planning needs and see if I can give you some advice. Today's agenda is the importance of financial forecasting. David is going to walk us through two sample scenarios. The first is about a couple that is building towards retirement, and the second scenario is a couple in retirement. And then we're going to give you some additional financial planning tips that everybody should be aware of. For all of our clients, they get to experience the power of the financial forecasting. This is done for clients at least once a year and more frequently as more major financial choices are being decided on. Those more major financial choices can be anything from when should they retire? How much should they spend in retirement? Do they have enough? That is a huge question that gets answered. Can they afford to gift? Can they afford to buy that second property? What does estate taxes look like? How can we mitigate those? It really is a great tool that provides a lot of peace of mind because it helps visualize the goals. And it takes what's happening today, so your wealth today, how it's being invested, how you're spending your money, and it looks out over a long period of time to show you what that looks like in the future. It really is a great tool to empower that decision making. And we encourage everybody to make sure that you have done a financial forecast and that you have that ongoing discussion. Let's jump into the sample scenarios.
Thanks for that, Jen. And before we get started, I do want to make sure to set this up properly. This is something that if you've never done with your own financial advisor, we really do highly encourage it. It's something that we do with our clients at least once a year, and it's something that they really do truly find value in. Now, if we go to the next slide, we will be able to see sort of what we're looking at in terms of our first scenario. But before I jump into any of that, I do want to emphasize that the numbers we're looking at today, they are essentially picked at random. We are using them for information purposes to be able to try and portray the concept. So whether you're spending, $5,000, $10,000, $25,000 a month, the concept will still hold true. Now, in this scenario, we are looking at middle-aged professionals who are trying to determine whether or not they will be okay for retirement. This is one of the more common ones we see because I think a lot of people, they spend their lives saving and saving without really knowing what that equates to. They don't really understand if I save, $500, $1,000, $5,000 a month, what does that ultimately mean when I'm retired? What can I ultimately do with that? And will I be able to meet my own goals? So that's something then we're able to determine, yes or no, if it's possible. But not only that, we are able to then provide you with solutions to be able to get there if you're not happy with that result. So what you're looking at here on screen is just a snippet of something that we do use in all of our meetings. So it's something that you would get very, very familiar with if we did start working together. And what you're seeing are the assumptions on the left-hand side. So in this case, we have Mr., who's 45 years old, earning $90,000 a year, Mrs., 47 years old, earning $120,000 a year. They are expecting to retire in approximately 20 years at 65 and want to live their retired life for 30 years, so to age 95. They're looking at spending $10,000 a month. And in this scenario, we're using a 5% rate of return. It's more of a conservative rate of return. Your actual rate will vary based off of your own portfolio construction. But again, for conceptual purposes, we have to pick a number. We are using a 2% rate of inflation. And in this case, this couple is renting. So that is going to be a fixed cost for, their lifestyle at the moment. They're assuming that they're going to receive their maximum old age security and Canadian pension plan benefits at retirement. In terms of what they've actually done up to this point for their own savings, neither of them have a group or work plan, but they do have approximately $300,000 in RSP savings. So Mr. has 120,000, Mrs. has 180,000. And in their TFSAs, they each have $100,000 each. In terms of a monthly annual savings, they're saving 10% of their gross monthly income. So they've just, always heard that saving 10% will get them there. So that's what they've done. Now, if we look at the right side of things, we can see that following these assumptions, this couple actually will not be able to sustain the lifestyle that they're looking for. So again, they've been saving all their lives, but they're not going to be able to get there by just continuing on the path that they're on. They would actually run out of liquid assets at their respective ages of 85 and 87. So it leaves them with their final 10 years of life without any sort of funding outside of their government benefits. So what is, what's supposed to be your most maybe vulnerable time of life, you're now relying on just what the government is providing. Now, for the more visual learners out there, I do have a chart on the following page, and you will see the black line really illustrates the needs. So that's what we're trying to accomplish year over year, every year. The green bars are your abilities to meet those needs. And what you can see is up to 2059, this particular couple is able to meet their needs in its entirety. But what happens in the following year, in 2060, there does begin to be a bit of a shortfall. So we want to be able to address this shortfall and try and provide this couple with a peace of mind, knowing that they will be okay in retirement. So we want to, from this point of view now, be able to create a conversation, spark the conversation, and look at what our options are at this point in time. So what can we do to get there? So we do essentially have 4 options to look at. And you'll see the 4 options that we have are either reducing your spending, retiring later, saving more, or a combination of the above. So like I said, we do have actual tangible figures that we've incorporated here. So if we're looking at, say, reducing spending, so not able to save anymore, and I still want to retire at age 65, those are 2 things that are more important to me or just sort of within my realm of control, well, then we have to reduce your spending. And we have the conversation around, well, you can't spend $10,000, but you can spend $8,300. Is that something that would work? And if it's not, well, we can start to make some tweaks and some adjustments to try and get us closer and closer to the $10,000. But if you tell us that $10,000 is non-negotiable, you already have everything planned out exactly as is, you can't budge on that number, well, then our next option, which is retiring later, is something that we can explore further. So in this particular case, we're looking at retiring at their respective age of 69. So Mr.'s age 69 and Mrs. is age 69 instead of age 65. So we're working 4 more years, we're saving for 4 more years, and that's 4 less years that have to be funded. But again, if you tell us that, I can't work until 69, I just don't want to do that, that's not appealing to me, and I don't want to spend less than $10,000. So our third option then becomes being able to save more. And in this particular instance, we would then be looking at having to save an additional $1,830 a month. Either that, or we can do a lump sum contribution of approximately $251,000. Now, for some, they might just need to know the number, and that's no problem. I just wanted to know what I had to do, and I'll go ahead and do it. So that's perfect. Or maybe you're expecting an inheritance soon. Unfortunate circumstances, you're expecting an inheritance, so that lump sum isn't going to be a concern either. So we're able to then meet your needs. But if you're not able to meet those needs, what this does is, again, it sparks further conversation in terms of, well, what can we do with your budgeting then? You know, maybe we can start to make some, again, further tweaks, some further adjustments to maybe not get us all the way there, but start to push us in the right direction. But if you're not willing to commit wholeheartedly to any one of these three options, because not one single option is really that appealing to you, our fourth option becomes, well, let's do a combination of all three and let's see how that looks. In this particular instance, what we do is, okay, we've gone through our budgeting exercise, we found an extra $500 a month, great. So we'll start saving that. You know, we've discussed the spending. I can't do $8,300 a month, but $9,200 is reasonable. I can work with that. And then again, you know, working a little bit longer instead of, you know, to 69, I think I'd be okay with working until I'm 67 years old. So ultimately, again, for those visual learners, what we end up seeing on our following page is, you know, all green bars. We can see in every given year that our need is met. And that's sort of the power of the projections, is we can work through the numbers, we can come up with solutions, and we can have a conversation, which will ultimately, ideally, lead us to all green through your entire lifetime. Now, it is important to obviously understand that everyone's situation is different. You know, the scenarios we're looking at today truly are just a foundation for us, and they're providing us that foundation for us to be able to build upon and further personalize to you as an individual. The projections, they really do dive deeper than obviously just providing you with that peace of mind leading to retirement. Now, as we mentioned already, it can help you in your day-to-day budgeting, your major purchase planning, your major life decisions even. So there's a whole plethora of things that can be done just by planning ahead and by having those conversations. Now, we do have a second scenario here for you as well, as Jen mentioned. And in this scenario, we're looking at newly retired couple. So a newly retired couple, they have different needs and are looking at, you know, projections probably a little bit differently than, you know, a middle-aged professional, because at this point in their life, you know what, they've retired, they have what they have, they're not looking to work any longer, they're not looking to reduce their spending or having to save anymore. They're already retired. Now, it is still very valuable in terms of providing a retired couple with peace of mind, because I think at any stage in life, everybody is looking for peace of mind. You know, it's very, very important for everyone. But some common questions and common themes we'll try and get through for this scenario is, you know, how do I most effectively recreate my paycheck? I've been saving, you know, year over year for the last 4 years, but now how do I draw that money back out in the most efficient way to be able to now pay myself and sustain my lifestyle? And outside of that, you know, another question we get is, what can I do with my estate? You know, I've saved again all this time, and I've now accumulated this great big estate that I'm looking at. What does that mean? So it's a bit of a role reversal from our previous scenario where, you know, the couple is looking to try and determine what they can do or what it looks like. And now we have what we have. We have this great big estate, and that provides this couple with, you know, great opportunities moving forward. And then lastly, you know, a big piece is, will my partner be okay if I were to pass away prematurely? And that's a big peace of mind for many, many people. So looking at this scenario, then again, we see both are age 65 and they want to live their retirement for the next 30 years. We're still using that $10,000 a month spending, 5% rate of return, 2% inflation. And then in this particular case, this couple does own a home. So they own a home market value is $2 million. We have real estate appreciating at 3%. In this case, both of the couple are receiving maximum old age security and Canadian pension plan payments. And, you know, for this couple, they're empty nesters already. So they've already determined that in 10 years, we're going to downsize our home to a home that's approximately half the cost, and then reinvest those proceeds. So in terms of what they've already done to get them there to this point in retirement, you know, we look at Mr. who has $30,000 a year, non-indexed defined benefit pension. They've accumulated $800,000 in RSP assets. So Mr.'s got $250,000, Mrs. has $550,000. And then they both do have $100,000 in each of their tax-free savings accounts. And additionally, they do hold a joint non-registered account, which holds $300,000. So on the right-hand side, we can see that this couple is in great shape. They're going to have an estimated estate value of $4 million. Now that's going to be comprised of their liquid investments as well as their home value, but they're going to have that $4 million. So to jump to our next slide to try and show you a bit of what else we do with this and elaborate on my earlier point of how do I recreate my paycheck. Well, this is again a snippet, so of the next 9-10 years of the sources of income for this couple. You can see the pension income of $30,000, the joint government benefits of $35,425, and then the remaining amount is just coming from the non-registered assets. So for them to meet their $10,000 a month need, they're just pulling the money from the non-registered account. Now, again, there's no tweaks or anything that has been done in this situation. So what this couple is doing is they're pulling out all of their non-registered assets because they've always been told, let's defer our RSP assets for as long as possible to take advantage of that tax deferral. So they're pulling all of their money out from the non-registered assets from one pot, and then they're just turning to the next pot, which is their RSP assets, the TFSA assets, once the non-registered assets are depleted. Now, is that the most efficient way of doing things? Well, likely not. And we're able to try and then determine now for the next 30 years, what is going to be the most efficient way for you to pull that money out to maximize what you've saved to this point, and also to help maximize, your government benefits. One other thing we do see here is in the last row, year 2029, we can see the registered account is pulling out $84,000. We see the total cash inflow at $162,000. And that's starting to get close to the level of, the OAS clawback for this couple. So we want to make sure that we're obviously cognizant of, your taxes, your clawback, and the most efficient way to provide you with that income on a year-over-year basis. Now, to my next point, we do have another slide which does dive into that $4 million estate. So on the next slide here, we'll see, again, as I mentioned, $4 million estate. So what does that then ultimately mean for me as the client? I have $4 million left over. I've met my goals and I've actually exceeded my goals. So now we have the fun of exploring, well, maybe instead of $10,000 a month, I can spend $15,000 a month. So I can, go on an additional trip or a couple of extra trips every year. Or, you do have options in terms of gifting prior to death. So you have kids, it's becoming increasingly difficult to get into the housing market, and they just need a little bit of help. So you want to see if you're able to provide them with a lump sum and be able to do that without negatively affecting your own retirement, because you want to make sure at the end of the day, you're still going to be okay. And that's something that, when we run the numbers, we're able to determine. And again, it's really just having that number to work backwards from, so we can then have the conversation and determine, well, this is what you can and can't do. What's important to you? And if this is important to you, well, how do we accomplish that then? Another point of importance on this particular slide is the additional taxes for the estate. So, maybe you see that and you don't want the government to get more taxes at your estate. So you want to then plan ahead. So we then have 30 years to create the best possible outcome for yourself by mitigating that taxes over the next 30 years throughout your retirement. On the other side of the fence, you could also be thinking, you know what, I'm leaving a great big estate of $4 million going to my heirs, and they can deal with this tax bill because, they're going to get, great big lump sum anyways, right? So what's really important here is, again, just having that conversation and working backwards from that. And if that's what's important to you, great, let's go that direction. But we need to know sort of ahead of time so we can then plan accordingly to, again, create sort of the best potential outcome. So with this, if you are interested in learning how to mitigate those taxes, if you want to determine if you're able to retire comfortably if you continue doing what you're doing, or if you're interested in just trying to figure out how to recreate that paycheck, there are tons of options that we can further explore. I will be posting a link just in the chat box in a second here, where you'll be able to book a conversation with Jennifer to be able to get the ball rolling. And with that being said, I'll pass this back over to Jennifer.
Thank you, David. That was really interesting. It was great to hear the two different scenarios, and you gave us all a lot of financial planning tips throughout in terms of the adjustments that could be made and the options that are presented, especially knowing the options for the retired couple, knowing those options well in advance for them to, make maybe more fun choices while they're enjoying their retirement. Some additional financial planning tips that we wanted to address was the first is to avoid lifestyle creep. What this means is when we're still accumulating our wealth, as our salaries go up, we get increased bonuses, things of that nature. It's important that all of a sudden we don't just start spending more and more money. And then all of a sudden our lifestyle is much higher and that's not sustainable in retirement. And that would be a really hard adjustment. What we want to do instead is make conscious decisions. So be aware of our choices and see that, if let's say we get an increased bonus. Okay, well, now that bonus money, can we actually be, instead of increasing our lifestyle, can we be saving more? Is that a possibility? There are many times in our life where lifestyle creep is important. So let's just be very mindful when that happens. Now, lifestyle creep can actually happen in retirement as well. For some people in retirement, all of a sudden we have the government benefits, perhaps a pension, as well as the registered accounts have now transitioned into where a minimum must come out of the accounts. Perhaps you're getting more money than you really thought you wanted to spend. Well, instead of spending the money that goes into your bank account, let's again take a step back. Let's think about what was important to you, what were your objectives, and make sure that you're using that money to the best of what's going to help you and make you most happy with your financial choices, really. The next point is reinvest your tax returns. So if you get a tax refund, where does that money go? Should that go to maybe larger home repairs? Maybe you're allowed to pay down a chunk of your mortgage, or can it get reinvested? But again, make sure that you are aware of where that money is going and make sure that it's working towards your values and your goals. Third is pay yourself first. This concept is really important. It's for anyone accumulating wealth. It is the idea that you should set up automatic contributions going into your various accounts. Typically, you time it with your paycheck. That's the easiest way to do it. And you would make sure that the money is going directly into the right vehicle that makes most sense for tax planning purposes, and then is getting invested in the right way that is for what you're trying to achieve with your money. If that happens automatically, it's going to put you that much closer to achieving those maybe short and longer term goals. The fourth item is avoiding rules of thumb. There's 3 rules of thumb that we'll address. The first one is this concept of the 10% rule. And Dave showed us that in the first scenario with the couple that was building towards retirement. They had heard that a great rule of thumb is just save 10% of your paycheck, and that's what they were doing. But what they ended up realizing was that wasn't enough to sustain what they were trying to achieve. So I would say avoid the rule of thumb always. Make sure that you are really looking at, again, your specific needs, your specific desires, your specific circumstances, and that you have a financial plan that really is there to accommodate that. The second rule of thumb that we'll talk about is this idea of age and how it affects your asset allocation. So an asset allocation is the overall suggestion of how much you should have in stocks versus bonds, so equities versus fixed income. That is one of the most important decisions that will affect your investment returns and projections. So when Dave was using the assumptions of what the rates of returns were in our financial forecasting scenarios, he was using it based on what a conservative estimate would have been based on what the client had as their asset allocation. Now, there's this concept that as you get older, you should have more fixed income. It's not always necessarily true. And the rule of thumb that people might know of is if you take 100 and you subtract your age, so let's say the client is 60, you subtract 60, now all of a sudden you have 40, so 40% should be of your wealth should be in equity. That's definitely not something that we would recommend. 40% is likely for the majority of people not the right mix at almost any age to have in equity. And what you really should be doing is you should be looking at the financial forecast, looking at, again, your specific spending habits and objectives, and then making that asset allocation decision. So again, that is such an important part of working within a financial advisor to figure out that right mix that makes, again, most sense for you and your specific circumstances. The third rule of thumb, the last one we'll address today, is this idea that if you just pay out 4% from your retirement portfolios, and that's how much you should spend every single year. Again, what we're going to see is, I mean, what we saw in the second scenario with the retired couple, all of a sudden they have this large lump sum left over, and perhaps they're excited to leave money to their heirs in their estate, but they do wish they had taken that trip a little bit sooner. Well, having looked at the financial forecast, they would have seen that maybe that consistent payout every year doesn't make sense for them anymore, that they should be spending a little bit more, or maybe they should be spending a little bit less. So just make sure that always when you're doing investing and financial planning, it is based on your needs, and your needs evolve and change. So as a quick recap for everybody, financial forecasting is more than just knowing you will be okay. It is about setting you and your family up for long-term success. It takes away the surprises of the future and prepares you with the tools you need to achieve your goals. And financial forecasting is dynamic. Your situation can change slightly or significantly over the course of a year. So planning ahead is not about setting and forgetting, but an ongoing monitoring to ensure you are always on track to meet your goals. If you have any questions, we'd be happy to answer them now as well. You can schedule a conversation with us so that we can answer them in a private, more confidential setting. It is up to you, but we would definitely love to hear from you. So please feel free to use the link that's in the chat box, schedule a conversation with me. As well, Dave and I are both available to answer any questions you have or comments. And make sure you stay up to date about our upcoming webinars and other relevant investment and financial planning information. And make sure you're signed up to our newsletter if you're not already. There's a link going in the chat box now for you can click. You can use that to sign up for our newsletter. As well, follow us on social media. We have Facebook, Instagram, our YouTube channel, and LinkedIn. Thank you so much, and look forward to speaking to you soon.